DoubleLine Capital founder and CEO Jeffrey Gundlach. On this incredibly important day in the markets, Jeffrey, it is only fitting that you are here with us yet again. Welcome back.
Thanks, Scott. Thanks for having me back again. I think this is our 38th time after Fed Day, or 39th. I'm starting to lose count.
All right. Well, I'm glad we have continued the tradition. I really hit on that at the top. December is not a foregone conclusion. Far from it. Chair Powell went out of his way to say that.
Yeah, you're right. Yeah, you're right. In fact, that was going to be my phrase of the press conference. So you've got it. You're on the same page that I am. Not a foregone conclusion. And then he reinforced that with far from it. And then he went back to that theme a little bit later on in the Q&A when he said, what do you do if you're driving through a fog? You slow down, which is kind of sounds to me like if we don't have any more data, I think that we need to price out to a certain extent what was an assumption by the market that there was going to be almost with 90+% certainty a cut in December. And I would say that has been reversed, or should be reversed. It's begun to be reversed, but I think it should be reversed fairly substantially. I might even put it at 50-50 when he says that there's far from a foregone conclusion. I saw in the pregame before the Fed announcements, I saw Rick Santelli talk about how the 2-year Treasury and the 10-year Treasury haven't changed since the last meeting, and he's right about that. I'd amplify that point, though, that the 2-year Treasury is down since before the Fed started cutting, or the day after the Fed's first rate cut back in September of last year. The 2-year Treasury rate is down all of 5 basis points. That's it. And the Fed has cut rates 150 basis points. Meanwhile, the 10-year Treasury rate and the long-term bond rate are up since the first rate cut, steepening out the yield curve. And I think that one thing I've been contextualizing all through these Fed cycles is that the Fed tends to gravitate towards the 2-year Treasury yield with the Fed funds rate. So back in September of last year, there was about 150 basis point spread between the Fed funds rate and the 2-year Treasury, but the 2-year Treasury being much lower. But now that the Fed's brought the rates down, they're very much in the context of the 2-year Treasury now, with only about a quarter point difference between the two. So I think what's really happened here, of course, is that we've seen tremendous rallies in financial assets this year. I mean, everyone's focusing on the stock market in the United States, but Europe's done well as well. The emerging markets have done even better. And bonds have done surprisingly well versus most people's expectations. This is actually for the investment grade bond index that is most commonly followed. Out of the last 49 years, this is the 11th best year, following some pretty terrible years, particularly in 2022. So I think that we're looking at the possibility for a steeper yield curve. I think it's interesting that they're saying that they're going to let the maturing mortgage-backed securities, they're going to reinvest them in T-bills. And he mentioned in his comments, Jay Powell, that they want to reduce the duration of their balance sheet, which means that they're going to continue to emphasize shorter-term securities, which is curious because that's the interest rate that they can control, that the Fed can control. So if they're really interested in thinking about reducing interest expense on the now $38+ trillion national debt, it's a kind of a clever way to do it, to continue to manipulate balance sheet holdings into shorter dated securities, and then you can do QE again if you need to. And I think that they may ultimately manipulate mortgage rates lower by possibly doing quantitative easing when the environment calls for it, to get mortgage rates down. One of the biggest problems Jay Powell correctly talked about, in the inflation level has come down, but the price level is still very, very high versus 5 years ago. That also bleeds over into housing affordability, which is really bad compared to where it was 5 years ago. Home prices have gone way up, and mortgage rates are also higher than they were. And so it's just possible that they might want to buy mortgage-backed securities and get them to an even lower yield versus treasuries. I suspect that might be in the offing, not in the near term, but in the intermediate term. And so we're quite positive on the agency-guaranteed mortgage-backed securities market, in spite of the fact that it's done very well in recent months, now having more excess return versus treasuries than investment-grade corporate bonds, which have also done well. So it's been a great year for financial assets. A lot of that had to do with the Fed assumption of more Fed cuts. I would say that assumption is getting a little weaker after today's press conference.
I like your willingness to give us, and our viewers, of course, actionable ideas. It's interesting, when you say that maybe you're taking your own expectations for December down to 50-50, it obviously leads towards the road of the dissents, in which we got 2 today. Expected, of course, from Myron, who wanted 50 basis points, but Kansas City Schmid wanted none at all. I also thought it was newsworthy that the chair really underscored the idea of, in his words, decidedly differing views in the committee on what to do next. They got a battle in the room at this point.
That's what it sounds like, and it's understandable, you know, given the shortness on data and the fact that Jay Powell admits repeatedly that they've got a problem with their dual mandate. They're both going in the wrong direction, or at least inflation's not going towards 2% right now. It's over 3%, and we think it's going to stay above 3% year over year throughout, you know, things can change, but throughout 2026. So the mandate, it's difficult to figure out what to do when, you know, as he said, we only have the Fed funds rate at the Fed meetings, and you know, one mandate says cut it, and one says don't cut it, or even potentially raise it at the inflation rate. So yeah, there's a battle in the room, and I think that's going to continue going forward. You know, Myron is going to want 50 basis points every single meeting. I mean, that's where you're headed, and I suspect that's a taste of where we're going to be in, say, the middle of next year, when we have a new Fed chairman, which will probably be incrementally more dovish, and maybe more than incrementally more dovish than Jay Powell has been. So be interesting to see what's going on. I just really believe that there's chances for lower interest rates with the new Fed chairman that could be below the inflation rate, if possible. I mean, we've certainly heard Donald Trump, and to a certain extent echoed by Scott Bessent, that they want rates lower, and not lower doesn't mean 3 7/8 in the middle point of the Fed funds rate where we are now. So we'll see what happens, but right now we're just enjoying a really great year in financial assets. I think one thing that's I'd like the viewers to think about, you know, everyone knows that credit spreads are very tight, just like the stock market valuation is very high. Those things naturally go together. But the thing is, while corporate bond spreads in the investment-grade corporate bond market are tight, they're only about 75, some days 80 basis points more than Treasuries. That's a very tight level versus history. It's really never been significantly less incremental yield for corporate bonds. And the same is largely true of below investment-grade corporate bonds, excluding the CCC category, which has some stress in it. You have the tightest spreads in the high-yield bond market, but both the investment-grade corporate bond market and the high-yield bond market are better off in terms of their credit quality and their dynamics than they were back before the global financial crisis, which was the last time we had spreads this tight. People who think that the history echoes, they might be worried about corporate bond spreads, but there hasn't been much change in them. And the fact is that the junk bond market is actually smaller than it was in recent years, because a lot of the really bad credit is going not into the public corporate bond market. It's going into the private credit market. And that's actually a good thing for the public investment grade and junk bond markets, because it means that the junkier stuff that would be a tell on what the default rate you might expect in the public bond market, it might be overstated this time, because the defaults are showing up in more private categories. So we're not really negative. In fact, we added to investment-grade corporate bonds at our most recent strategy meeting for the first time this year, simply because we think the fundamentals are quite good. And also, we don't like Treasury debt at the longer end, and the corporate bond market tends to issue in the investment-grade side in the 10-year category. So to the extent you want 10-year maturities, I think you might be just as safe in corporates as you are in long-term Treasuries, because as the Fed eases interest rates and as the deficit grows, we've seen that in this easing cycle that started 13 months ago, long-term interest rates on Treasuries have defied history. They have not gone down. Yes, they've gone down in the middle part of this year, but they're still higher and significantly higher than they were back before the first rate cut last September. So we're avoiding the long end of the Treasury market. We'd rather have corporate bonds in the 10-year category. And we still like the best performing category more recently, which has been local currency emerging market debt, which is one of the best categories. Emerging markets broadly have done well. And if you're a dollar-based investor, you've done double well because you had done better on the index price changes, but you also have the currency translation, which translates to a profit for dollar-based investors. That's also true in the investment in the local currency emerging market bond market, which is the top performing sector in recent months. So we continue to be in that category. I have reduced my interest in gold once we got above 4,000. You'll remember all year I've been talking about kind of a radical prediction that gold would go over $4,000.
Yes, you did, including with me.
Yeah, and it's gone up. It went up to almost $4,400, which is really nosebleed levels. I mean, there are sentiment indicators called Market Vein, a service that polls investors on whether they're bullish or bearish on various categories, and you almost never get a bullish reading that's above the low 90s. But the gold reading a couple weeks ago was at 95, which is just unheard of. So last time we spoke, I talked about having 25% of a portfolio in gold or other types of hard asset things, which sounds high versus most people's recommendations, but it worked out pretty well. But I don't hold that any longer. There was somebody on the pregame that said what I think is now very timely investment advice, and that is, with all these market moves, you really want to think about rebalancing. Rebalancing is a very powerful tool. So you want to take things that are at nosebleed levels, like gold was a couple of weeks ago, and if you had 25% gold, it probably turned into 35% of your portfolio. It was time to rebalance back down. Right now, I think gold has to correct further. We've seen about a 50% correction, maybe 40% of its big up move. But I would put gold now in my portfolio down to 10%, and I would have 5% in other commodities, just a commodity index. So you'd end up with a little bit more than 10% gold and about 5% commodities. I still like 45% in stocks. You'd probably be higher than that now. You have to rebalance that because stocks have outperformed bonds. But I still like having some local, a dollar investor in emerging market equities. I still like that, and I like non-U.S. equities from a valuation perspective quite a lot. I like 25% in bonds, and it's the same game plan that we've been talking about. It's been working pretty much through the course of this year, and that's intermediate term bonds, maybe 2 years out to 10 years, with more in the 5 years than the 10 years. But also, not a lot of long-term Treasury bonds. We own very, very little of long-term Treasury bonds. We think the curve's going to steepen. And then we like these asset-backed securities and some commercial mortgage-backed securities, which I believe the market is starting to accept, even office commercial mortgage-backed securities. We're seeing interest. New York, there's always interest in Manhattan office, but we're starting to see better performance and better acceptance of Chicago office, and surprisingly, even some rumblings for San Francisco office. So this is a category that remains reasonably cheap. There's nothing super cheap in the entire financial markets right now, but we like and then I would have about 15% in cash right now, because I really think things are at a very aggressive level, not just gold, but which certainly was at 4,400. But I certainly think that a stock market which is very narrow in breadth. I know it's better than it was before, but when I started following the stock market, it was in the early 70s. I was 12 years old, but they called it the Nifty 50, and that preceded a pretty big correction down, a pretty big drop in 1974. But now we have the Nifty 7. I know it's a little bit broader than that now, but there's a huge difference.
It doesn't feel it sometimes.
I'm not a momentum investor.
I know. It doesn't feel it sometimes, because we do have those huge earnings coming up, so it's going to be front and center. Hang on with just a second. We're back with Jeffrey Gundlach, and the thing I wanted to talk to you about now is something else that the chair said towards the end there. I don't see a broader credit issue, is how he answered a question regarding private credit. You've had some of the issues around subprime auto. obviously, that we've all been focused on, wondering because of what Jamie Dimon said, there's never just one cockroach. You told me like 13 months ago that you were concerned, and this was out at Future Proof out in Huntington Beach. If you recall the conversation we had then, where I asked you, as everybody was talking about the prospects of a private credit bubble, you said you saw one. I'm wondering whether you now see the first cracks in it.
Well, there sometimes is one cockroach. I mean, with that Silicon Valley Bank, that was sort of a one cockroach situation. A lot of people thought that was the beginning of something, and I was suspicious that I thought it might be contained, and it turned out that was the case. But we are starting to see weaker activity in parts of the lower tiers of the credit market, and there's been more than one sort of write-down or default scenario that's already occurring, and they seem to be occurring kind of in a cluster. It's not like there's one and then 6 months goes by and then you get another write-down somewhere. They seem to be happening in a cluster, kind of like the layoffs are starting to happen in a cluster. So I think that private markets broadly have stopped outperforming public markets. That's certainly been the case in recent times with the public markets doing so well. I just think that there's going to be a liquidation that will occur in the next significant economic weakness period that is going to be surprising to people how much selling and unwinding there's going to be of what I think is an overinvestment in these private markets, both private equity and private credit. We're already seeing signs of some major asset pools that have got themselves into illiquid positioning because of significant investment in private markets, and they don't have any money. That was famously Harvard University back when they were getting, their donors were pulling back because it was going on campus. I think Yale's been talking about liquidating some of their private equity interests and the like. And that's usually the sign of overinvestment, and the liquidity will dry up and it will turn into sort of a liquidation cycle. That's my map. I don't think it has to happen this week,
right.
But it's been a process that's been developing over the course of this year. But I think that's going to be at the foundations of the next kind of financial problem that we have in the United States, and perhaps beyond the United States borders.
Yeah.
But certainly there's a lot of investment in that category. So I caution investors. I think if you have liquidity options, some funds, they allow a liquidity option. They'll give you a mark periodically on their private credit book, and if they allow a partial redemption and you don't see any degradation in the marks on the private pools, I would take advantage of that liquidity function, because I think you're going to be getting out at a better level than you'll be able to get out at in future quarters. So I'm very focused on private credit being an issue.
Okay, we'll follow that. There's certainly a lot of focus on it. You've given our viewers a lot to think about today and plenty of actionable ideas. For that, I thank you, and I look forward to our next conversation, which will be after the next Fed meeting, which now, who knows? Now what seemed to be a foregone conclusion, Jeffrey, is going to be anybody's guess. I look forward to being with you then. Thank you.